Something extraordinary is happening right now in the global financial system. And if you're not paying attention, you're about to miss one of the most significant wealth transfers in modern history. Central banks around the world are making moves that haven't been seen in decades. They're quietly accumulating gold at a pace that's breaking records, not just buying a little here and there. We're talking about systematic, aggressive accumulation that signals they know something the average investor doesn't. Let me paint you a picture of what's actually happening behind the scenes. For the past 70 years, the world has operated under a specific financial order. The US dollar has been the undisputed king. Countries held dollars in their reserves. Oil was priced in dollars. International trade settled in dollars. This system gave the United States enormous power and privilege, but that system is cracking, and the cracks are turning into fractures. Look at what central banks did last year. They purchased over 1,000 tons of gold. That's not a typo. 1,000 tons. To put that in perspective, that's more than the annual production of every gold mine in South America combined. And they're not slowing down. If anything, they're accelerating. China's central bank has been buying gold for 18 consecutive months, 18 months without a single pause. The People's Bank of China added another 23 tons just in recent months. But here's what's really interesting. Many analysts believe China is buying far more than they're officially reporting. Some estimates suggest their actual reserves could be double or even triple what they publicly acknowledge. Why would they hide it? Because if the world knew the true extent of their accumulation, gold prices would explode before they finished building their position. Poland just announced they're increasing their gold reserves significantly. Turkey has been on an absolute buying spree. India's central bank continues to add to their holdings. Singapore, Thailand, Czech Republic, even countries you wouldn't expect are loading up on physical gold. This isn't random. This is coordinated preparation. Now, you might be wondering what they're preparing for. Let me connect some dots that the mainstream financial media conveniently ignores. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, have been working on something that could fundamentally reshape global trade. They're developing alternative payment systems that bypass the dollar entirely. They're discussing a trade settlement mechanism that could be partially backed by gold and other commodities. Think about what that means. For decades, if country A wanted to buy oil from country B, they needed dollars to complete that transaction. This created constant demand for US dollars, which allowed America to print money without immediate consequences. But if major economies start trading directly with each other, using their own currencies or a gold-backed system, that dollar demand evaporates. And it's not just BRICS. Saudi Arabia, the cornerstone of the petrodollar system, has been making moves that would have been unthinkable 5 years ago. They're now accepting yuan for oil sales to China. They're in discussions to join BRICS. The country that helped create the petrodollar system is quietly preparing for a post-petrodollar world. Let me tell you a story that illustrates where this is heading. Back in the early 1970s, the United States faced a similar moment of reckoning. The Vietnam War had drained the treasury. Foreign governments were losing confidence in the dollar. France actually sent warships to New York Harbor to demand their gold back from Fort Knox. President Nixon had a choice: honor the gold standard and watch America's gold reserves disappear, or break the promise and close the gold window. He chose to close it. On August 15, 1971, Nixon announced the U.S. would no longer convert dollars to gold. It was supposed to be temporary. That was over 50 years ago. What happened next? Gold went from $35 an ounce to over $800 within a decade. That's not a 20% gain or even a 100% gain. That's a 2,000% increase. People who understood what was happening and positioned themselves in gold before that shift created generational wealth. We're at a similar inflection point right now, except this time, it's not just about the US dollar's relationship with gold. It's about the dollar's role as the global reserve currency itself. Here's something most people don't realize. When you look at global reserve holdings, the dollar's share has been steadily declining. It's still the largest, but the trend is unmistakable. Countries are diversifying away from dollar-denominated assets. And what are they diversifying into? Gold, other currencies, and increasingly, hard assets. The European Central Bank recently published research suggesting central banks should hold significantly more gold than current levels. The Bank for International Settlements, essentially the central bank for central banks, has been reclassifying gold as a Tier 1 asset, putting it on par with cash. These aren't minor technical adjustments. These are fundamental shifts in how the global financial system views gold. Now, let's talk about what's happening in the physical gold market, because this is where things get really interesting. The London Bullion Market Association, the LBMA, is the center of the global gold trade. Massive amounts of gold change hands there every day. But recently, something unusual has been happening. The amount of physical gold available for delivery has been declining. Not gradually, sharply. At the same time, gold is flowing from west to east at unprecedented rates. Refineries in Switzerland, which process most of the world's gold, have been working overtime to convert large gold bars into smaller ones that meet Asian specifications. Why? Because physical gold is being shipped to China, India, and other Asian nations at record levels. Think about what this means. The West is selling paper gold, financial instruments that represent gold but aren't actually backed by physical metal. The East is buying physical gold and taking delivery. They're draining the vaults. There's a term for this in markets. It's called a squeeze. When physical demand exceeds available supply, prices don't just rise gradually. They spike violently. We saw a preview of this a few years back when the gold price suddenly jumped and premiums on physical coins and bars went through the roof. Dealers couldn't keep inventory. Mints couldn't produce enough coins to meet demand. That was just a taste of what's coming. Here's why this matters to you personally. Most people have their wealth in three places: real estate, stocks, and cash. Real estate is illiquid and vulnerable to property taxes and local economic conditions. Stocks are at historically high valuations and completely dependent on the continuation of the current system. Cash is being devalued by inflation every single day. Gold is different. It's been money for 5,000 years. It's survived the fall of empires, the collapse of currencies, wars, depressions, and every financial crisis in human history. It's the ultimate insurance policy against systemic failure. But here's what most people get wrong about gold. They think of it as an investment that needs to go up in value. That's not the right framework. Gold doesn't go up in value. Gold is the constant. It's everything else that fluctuates around it. An ounce of gold bought roughly the same amount of goods 2,000 years ago as it does today. A fine men's suit, about a year's worth of food for a family. These ratios have remained remarkably stable across centuries. What changes is how many dollars or euros or yen it takes to buy that ounce of gold. When gold's price rises in dollar terms, it's not really gold going up. It's the dollar going down. Gold is simply reflecting the loss of purchasing power in fiat currencies. And right now, with governments around the world printing money at unprecedented rates, with debt levels that can never be repaid through normal economic growth, with the global reserve currency system showing cracks, gold is telling us something important. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, how the process actually works, and what to watch out for. Worth checking out if that's relevant to your situation. Anyway, back to where this is all heading. Let's talk about what happens when the shift accelerates. Because it's not a matter of if, it's a matter of when. Imagine you're a pension fund manager or a sovereign wealth fund. You've got billions of dollars to protect. You start seeing the dollar's dominance eroding. You see other central banks buying gold aggressively. You see the BRICS nations building alternative systems. What do? You can't wait until everyone else figures it out. By then, it's too late. You need to position before the crowd, so you start allocating to gold. Maybe just a small percentage at first. But then other institutions see what you're doing. They start allocating too. This creates a feedback loop. As more institutional money flows into gold, the price rises. As the price rises, it attracts more attention. More buyers enter the market. The available physical supply gets tighter. Premiums increase. The squeeze intensifies. This is exactly what happened in the late 70s. Gold went from $150 an ounce in 1977 to over $800 by 1980. That's a five-fold increase in just 3 years. People who positioned early made fortunes. People who waited until gold was already at $500 still did well. People who waited until it hit $800 bought at the top and watched it decline for 2 decades. Timing matters. Now, I'm not saying gold is going to quintuple in 3 years. I'm saying the setup today is even more extreme than it was in the 70s. The debt levels are higher, the money printing is more aggressive, the geopolitical tensions are more severe. And most importantly, the structural shift away from dollar dominance is further along than most people realize. Some analysts are projecting gold could reach $4,000 per ounce within the next few years. Others think it could go even higher. The World Gold Council has published research suggesting gold is significantly undervalued relative to the money supply and debt levels. But here's what's really important. It's not about trying to predict the exact price. It's about understanding the direction and positioning accordingly. Let me share another historical parallel that's incredibly relevant right now. In the early 2000s, gold was trading around $300 an ounce. Most investors ignored it. Stocks were exciting, real estate was booming, gold was boring. But a small group of investors saw what was coming. They saw the housing bubble inflating. They saw the excessive leverage in the financial system. They saw the Federal Reserve keeping interest rates too low for too long. Those investors started accumulating gold, not because they knew exactly when the crisis would hit or precisely how high gold would go. They bought it because they understood the system was unstable and gold was the logical hedge. When the 2008 financial crisis hit, gold didn't crash like stocks did. It held its value. Then, as central banks around the world launched unprecedented stimulus programs, gold took off. It went from $700 in 2008 to over $1,900 by 2011. The investors who positioned early didn't just preserve their wealth. They multiplied it while everyone else was watching their portfolios get decimated. We're in a similar setup right now. Actually, it's worse. The debt levels are higher, the asset bubbles are bigger, the geopolitical risks are more severe, and the central banks have far less ammunition to fight the next crisis because interest rates are already low and their balance sheets are already bloated. When the next crisis hits, and it will hit, gold is going to be one of the few assets that not only survives but thrives. Here's something else to consider. The gold mining industry is facing serious challenges. Production has been flat or declining for years. It's getting harder and more expensive to find new deposits. The easy gold has already been mined. What's left requires going deeper, into more remote locations, with higher costs and longer development timelines. This means even if demand stayed constant, which it's not, supply constraints alone would push prices higher. But demand isn't staying constant. It's accelerating. Central banks are buying. Asian consumers are buying. Institutional investors are starting to allocate. And retail investors are beginning to wake up to what's happening. You've got declining supply meeting rising demand. That's the classic setup for a major price move. Now let's talk about the paper gold market, because this is where things could get really explosive. The COMEX, the Commodities Exchange where gold futures trade, operates on a fractional reserve system. For every ounce of physical gold in their vaults, there are multiple claims on that gold through futures contracts and other derivatives. Some estimates suggest the ratio is over 100 to 1. That means for every actual ounce of gold, there are more than 100 paper claims. This works fine as long as most people are content to trade paper and never ask for physical delivery. But what happens when a significant number of contract holders demand physical gold? The system breaks. There's not enough physical gold to satisfy all the claims. Prices would have to rise dramatically to either attract new supply or convince holders to sell. This is what's called a short squeeze, and in the gold market, it would be absolutely massive. We've already seen hints of this. During periods of stress, the spread between paper gold prices and physical gold prices widens significantly. Premiums on coins and bars spike. Delivery times extend. These are warning signs that the paper market is becoming disconnected from physical reality. If that disconnect becomes severe enough, the entire pricing mechanism could break down. The price discovery would shift from the paper markets to the physical markets, and physical markets are much smaller and less liquid. That means much bigger price moves. Think about what happened with nickel on the London Metal Exchange recently. A short squeeze forced the exchange to halt trading and cancel trades. The price went absolutely parabolic because there wasn't enough physical metal to cover the short positions. Now imagine that happening in gold, a market that's far more important to the global financial system. The implications would be enormous. Here's another angle most people aren't considering. The younger generation, millennials and Gen Z, have grown up in a world of constant currency debasement. They've watched their purchasing power erode. They've seen housing become unaffordable. They've witnessed multiple financial crises. They don't trust the traditional financial system the way previous generations did. This generation is increasingly turning to hard assets. Some are buying Bitcoin and cryptocurrencies, but many are also discovering gold. Not their grandfather's gold coins sitting in a safe deposit box. They're buying gold through modern platforms, storing it in allocated vaults, trading it digitally. They're combining the ancient stability of gold with modern technology. This represents a massive new source of demand that didn't exist in previous gold bull markets, and it's just getting started. Let me bring this all together and show you why the next few years could be absolutely critical. You've got central banks accumulating at record levels. You've got the BRICS nations building alternative payment systems. You've got the dollar's share of global reserves declining. You've got physical gold flowing from west to east. You've got supply constraints in the mining industry. You've got a paper gold market that's potentially unstable. You've got institutional investors starting to allocate. You've got a new generation discovering gold. And you've got governments around the world printing money like there's no tomorrow. Every single one of these factors points in the same direction: higher gold prices, significantly higher. But here's the thing: the opportunity exists right now, while most people are still asleep. Once this becomes obvious to everyone, once gold is on the front page of every financial publication, once your neighbors are talking about it at dinner parties, the easy gains will be gone. The smart money is positioning now. Central banks are positioning now. Sovereign wealth funds are positioning now. The question is, are you? This isn't about getting rich quick. This is about protecting what you've worked your entire life to build. It's about making sure that when the system shifts, and it is shifting, you're on the right side of that shift. Gold has preserved wealth through every crisis in human history: the fall of Rome, the collapse of the Spanish Empire, the hyperinflation of Weimar Germany, the Great Depression, the stagflation of the 70s, the financial crisis of 2008. Every single time, gold protected those who held it. The world order is changing. The financial system that's existed for the past 50 years is being challenged. New powers are rising. Old alliances are fracturing. The rules are being rewritten. In times of great change, there's great risk. But there's also great opportunity. The opportunity to position yourself ahead of the shift, to protect your wealth, to potentially grow it significantly. But that opportunity won't last forever. The central banks know what's coming. That's why they're buying. The question is, do you know what's coming? And more importantly, are you prepared? The massive shift in world order isn't something that might happen someday. It's happening right now. The evidence is everywhere if you know where to look. The gold market is screaming that something big is coming. The only question is whether you're going to listen.